Nike. This Group 3's strategic analysis and recommendations. Our team was engaged by Nike Incorporated to conduct a strategic analysis. We identified key problems and provide a recommendation plan of action for correction of any issues identified. Our review and subsequent analysis was concentrated on the following areas: general environment, industry environment, competitor analysis, internal analysis, key problems, and recommendations. Current situation of Nike. Located in Beaverton, Oregon, designer, manufacturer of retail footwear, sporting goods, and sports equipment. As of May 31st, 2014, $27,799,000,000 in total revenue. As of May 31st, 2014, $12,446,000,000 in gross profit. Stock price, $111.90. Primary competitors, Adidas, Under Armour, and Skechers. General environment. Nike is a global corporation that competes in economic markets worldwide. Because of the breadth of its operations, Nike competes in various markets including manufacturing, product development, and retail sales. Main markets include Europe, the US, and China. Socioculture. Nike has performed well in this segment in terms of promoting gender equality in sports, promoting fitness, and providing good wages and benefits to corporate employees. Nike has failed in this area in regards to wages and working conditions of those employed in its manufacturing facilities. Although accounts vary, Nike is perceived as operating sweatshops. Brand image took a large hit over the past few years due to this perceived image. They are looking to rectify the situation. Nike is a global brand with worldwide sales. It is therefore subject to fluctuating national economies, pricing structures, and sales markets. Technological. Nike has a history of innovation in sporting goods and equipment. This applies to technological advances as well. Examples include incorporating sensors into clothing and footwear, studies in schematics, and the fuel band. Political or legal environment. As a global firm, Nike is subject to the political and legal structures in each country in which it operates, including tax structures, currency fluctuations, and legal requirements for businesses. Demographics. Nike targets athletes of all ages, abilities, and experience levels. Industry analysis, 5 forces. Bargaining power of buyers. Buyers of Nike are end users and dealers. End users typically have low bargaining power. Dealers ask for margins as high margin improve the bargaining power of buyers, as is the case for Nike. Nike has been able to reduce the prices of its products due to comparably high prices than the rest of the industry. Bargaining power of suppliers. Nike's footwear products are made up of foam, cotton, and rubber, and synthetic rubber. This reduces the bargaining power of suppliers because there are few supplies to be substituted. Additionally, these goods are readily available all over the globe, and there are many potential suppliers eager to supply material to Nike. Threat of new entrants. The footwear industry has a lot of unexplored potential, so many firms are trying to enter the market. They're trying to sell their products by keeping their costs low and without a popular and strong brand name like Nike. Customers who are happy with the basics are attached to these types of firms, but Nike has an edge of strong brand name and image which has been a plus point of the firm. Threat from substitute market products. For Nike, this threat is quite low for many reasons. Nike specializes in footwear, and more specifically, athlete footwear. All of the competitors of Nike are also manufacturing footwear, but with different characteristics, and they are manufactured for an entirely different segment of customers and athletes. But since it is the age of innovation and creativeness, Nike should be prepared to deal with any of the potential substitutes. Inter-firm rivalry. At Nike is high as compared to other industries. Like others in the industry, Nike is fighting for its share of the market to maintain profit margins. In this industry, many small firms are emerging and taking small chunks of customers from the target market. For companies like Nike, it's become difficult to maintain their potential profits levels. As a big firm, Nike must look for other ways to keep their potential market, such as being strategic about differentiating its projects in an innovative way or simply reducing prices. Competitor analysis. Stock price. Nike's price is on a consistent upward trend. Skechers' price started low but has not dropped and is now ahead of Nike. Adidas and Under Armour are experiencing more volatility in stock price. As you can see, over the past 3 years, Skechers has increased, purple line. Nike's fell to below $60, and they are now up over $111. Adidas and Under Armour are right around the $80 mark. Current ratio. Nike, Under Armour, and Skechers performing more consistently. High current ratios, such as Under Armour and Skechers in early 2013, could be negatively perceived as the firm not utilizing cash assets appropriately. Adidas has a low but adequate current ratio, may have difficulty in securing investment funds. Gross profit ratio. Nike and all of its competitors show consistent sales through a steady gross profit ratio. You can see Nike is about even with Skechers, Under Armour, and Adidas are just below 50%. Net profit ratio. The difference between gross profit ratio and net profit ratio tells us that firms have high production and sales costs. This was particularly the case for Adidas in late 2012 and late 2014. Because gross profit was consistent during this time period, the dip in net profit was a result of increased expenses. Competitor analysis. Adidas. The business level strategy of Adidas is one of diversification. Adidas has a diverse brand portfolio, which is number one of their 6 key strategic pillars. This approach enables them to better set and respond to trends more effectively, in order to keep a competitive edge. Also, they know that athletes and fashion lovers with sporting lifestyles differ in their needs, habits, fitness level, motivations, and goals for playing and enjoying sports. The average selling price of a comparable item, like running shoes to Nike, is pretty close. $120 for Nike, $110 for Adidas. Adidas is also the second biggest player in the Chinese market and have recently seen large amounts of growth. Under Armour. Under Armour's business strategy is also like its competitors in that they follow a differentiation business strategy. They started differentiating themselves when they were the first athletic company to use synthetic materials when producing its clothing. After competitors started to implement the same type of technology, they had to change their business strategy a bit. They started to diversify their brand portfolios like Nike and Adidas when they dived into the shoe market. They also create other athletic gear like baseball gloves, headbands, etc. to help differentiate. Their average selling price on running shoes was around $100 compared to Nike's at $120. Skechers is a company that's gone from a cost leadership business strategy to a differentiation strategy. They used to be a company known for making cheap knockoff products from the other big companies that they were competing with. But now they moved into a differentiation strategy where they make athletic shoes for men, women, and children, along with a fashion line. Skechers also makes work shoes, most of which their competitors do not. They were also able to get a big spokesperson for their teen line through Demi Lovato. This move has boosted them up to being the number 2 competitor right behind Nike. They still compete with a lower price point than most of their competitors, which is a big reason of their success. The average selling price for their shoes is $90, which is the lowest of the competitors. Key resources for Nike. As the largest footwear and sporting goods manufacturer in the world, the biggest resource Nike has is its brand. Few companies are recognized by simply a symbol or logo, but the Nike swoosh is known worldwide. Nike's brand is an intangible resource that has grown the company to become a powerhouse of U.S. and international marketing. Nike's strong financial standing is another resource. Nike stock is currently trading at $110.52 on the New York Stock Exchange. Nike's internal financials indicate a strong balance sheet. Nike's most recent reported current ratio is 2.72. This indicates that Nike has sufficient assets to cover all obligations and liabilities, but also that it's using its assets appropriately by reinvesting in the company or issuing stock dividends. A strong financial position allows a firm like Nike to both borrow capital when needed and generate funds for internal operations. Capabilities. Nike has successfully leveraged these resources in order to build its capabilities such as product innovation and effective sales and marketing. Because of its strong financial resources, Nike is able to pursue new and innovative ideas such as Nike Fuel, discussed above. Nike is able to invest heavily in research and development. As you can see, a comparison of mixed patents from 2006 to 2013, Patents for 2013 is at almost 540 for the year. Branding is a core competency for Nike. This is evidenced by the fact that President of the Board is a position on the leadership team. Nike stands alone in terms of brand recognition and brand power. This recognition has allowed Nike to receive numerous endorsement deals and partnerships, such as the well-known Air Jordans. Manufacturing is another core competency for Nike. Nike has manufacturing facilities and supplier partnerships around the globe, focusing on areas where it can operate at lowest cost. Nike has massive economies of scale that allow it to operate successfully in multiple locations. Having diverse networks allows Nike to avoid increased costs on labor, shipping, and supplies. Key problem areas. Failure to penetrate Chinese market. At the current time, the main problem facing Nike is its failure to see success in China and Japan. As of last year, Nike has failed to post an increase in revenue for 5 straight quarters, ending a streak in 2014 according to Forbes. Due to this problem, Nike has seen problems appear such as accumulation of merchandise, growing competition led by Adidas, and Nike's missing out on a growing consumer market that Forbes says over the last 7 years, the market has grown at a compounded annual rate of nearly 30%. Nike has begun seeing success in the Chinese market, but they are still not doing as well as they had hoped. Our recommendations to alleviate this problem. Number 1, start from scratch, redefine target market, and investigate cultural barriers. Nike has failed to appeal to the consumer market in China by not understanding the culture. We would recommend starting over and targeting the youth of China. Surveys and questionnaires would help determine the current standing of Nike in China and help to determine where they have been coming up short in terms of marketing and positioning in the marketplace. This will enable Nike to re-engineer their business plan in China and set new goals. 2. Learn from the competition, imitation. Other companies such as Adidas are beginning to see success in China. Adidas has been able to appeal to customers as a youthful and fashionable brand according to Forbes, and by doing so is seeing growth in revenue. By looking at what Adidas has been able to do, Nike should determine what has made them successful, such as selling ponchos, skinny jeans, and gingham shirts, and look to imitate and compete on a similar level. This would increase revenues and simultaneously hurt the competition. Third option, offload current merchandise. Nike has positioned themselves as selling high-end, high-performance apparel. Due to the current surplus of merchandise, they have had to mark down and sell many of their products at a discount price. Nike is in jeopardy of hurting their brand image by continuing this practice. We recommend distributing the excess merchandise to outlet stores and distribution centers in the US and Europe in the hopes of maintaining their brand value in Asia. By using this strategy, Nike can maintain their brand image and continue to attempt to penetrate the Chinese market. Our recommendation: learn from the competition, imitation. We find this as the best recommendation for a couple of reasons. First, this will enable Nike to break into the growing market in the shortest amount of time without spending too much more on a completely new marketing strategy. Second, the marketing plan is already laid out for them. Nike has to imitate the strategy of Adidas and add a little of their own creativity to it. This allows Nike to increase revenue while hurting competing businesses. One of the main things Adidas has done is moved a little bit away from the fitness aspect and more towards the fashion aspect. If Nike is able to imitate this, they could add fitness to fashion and create new products and styles in China. The first thing Nike would need to do is implement this plan to find out what are Adidas' most profitable items in the market. Afterwards, Nike would be able to create or modify existing products that are similar to Adidas. It would also help to add a little bit of Nike's attitude to them to show that they are not just imitations but a better product. It would also help to add a survey for customers to fill out to get their thoughts on the product and what they want in the future by offering them a discount on products. This will help Nike understand what they were doing wrong originally and help them design new innovative products. This is our strategic analysis and recommendations for Nike for now and in the future. Thank you so much.